This is video 5, dealing with an example that combines IAS 8 with IFRS 9, specifically shares in IFRS 9. We are starting to look at the solution now. So the first requirement was to do the correcting journal entries for 2010. It can be posted in 2010. It needs to include the correction of the opening balance of the 2010 year. So step 1, what was done? Now, what was done was given to you in the information. They gave you the journals. If you look at the solution, the only thing that is different in the solution that was not given to you in the information was we actually show you how they calculated every single amount. So like on 1 March 2009, there was an acquisition. They recognized it as inventories. We gave you the amount of the journal in the given information. Now the calculation is just there. So that's the only thing that's different between this, what was done, and what we already gave you in the question. You didn't have to figure the journals out by yourself. You didn't have to figure the amounts out by yourself. We are just showing you how we got to those amounts. Then the second thing that you need to do is what should have been done. Now, what should have been done is in terms of IFRS 9, you should have accounted for these shares as shares. They weren't inventories. Shares you were trading at fall in the category at fair value through profit or loss. So you need to apply the rules of at fair value through profit or loss. So if we look at the first date, 1 March 2009, shares were acquired. What do you need to do on that date? Well, you need to recognize the acquisition. You need to know your rules. Debit the investment in shares at what amount? The fair value. Credit bank. Second thing that happened is on any acquisition and any sale, there was brokerage fee. Again, you need to know your rules. Brokerage fee in terms of at fair value through profit or loss is an expense that goes immediately through profit and loss, and therefore it affects retained earnings balance. You are not allowed to capitalize it to the investment, not allowed to be part of the cost of the shares in the category at fair value through profit or loss. Now, if you compare what was done and what should have been done, you will see that the bank amount is equal. This will usually, well, mostly, almost always be the case, because amounts went out of your bank, and that you will pick up very quickly because you do a monthly bank reconciliation, and at the end of the year you do a bank confirmation, have a look what is on your bank account at the bank itself, and you will very easily pick up that there was a mistake. You can see the money flowing. So the bank amount is usually not where the mistake occurs. What happened here and where there's differences is you recognized it as inventories. You should have recognized the fair value as an investment and the brokerage as an expense, where with inventories they included everything in the cost of inventories. Then we continue down the timeline, and on the 1st of July, there was a sale. So what was done? Well, first of all, the amount that was received, net amount, because they specifically told you of the brokerage, was recognized as revenue, and the cost of those shares that were sold was moved to cost of sales. That is in terms of IAS 2, what you would do if you had inventories. What should have been done? Well, first of all, it's on a date of sale. So you should have had a fair value adjustment on that date to get your shares to the fair value, then sell at fair value. Because if you are in the category at fair value, you should not show a profit or loss on sale. So first of all, fair value adjustment. Secondly, recognize the amount you received and de-recognize the shares at the fair value they are now. Take them out. You have sold them. You no longer have them. And then thirdly, because there was brokerage fee, you need to recognize an expense. Again, if you have a look, the bank amount will be identical. Makes sense because bank amounts, you would quickly see what goes in and out of your bank account. You would do bank recons. There's not going to be a difference on bank. Where are the differences? Well, you should not have had revenue and cost of sales. These are not inventories. What should you have had? Well, you should have had a fair value adjustment. You should have had transaction costs being recognized as an expense, and you should have had a movement in your investment. Because first of all, you did a fair value adjustment and then you de-recognized the investment. If you go further down the timeline, you get to the reporting date. Now, what was done? What was done is that the entity calculated the net realizable value. They had a look at what would these shares be sold for, net amount, so after brokerage fee. And they actually had, they actually had a write-down of the inventories to NRV. So inventories were credited, cost of sales were debited because that is the line item we include a write-down to NRV. What should have been done is that you had to calculate the fair value of the shares at year end and do a fair value adjustment in terms of the rules of IFRS 9. That can either be an upwards adjustment or a downwards adjustment, so it goes to other expenses or other income depending on the direction, as long as it goes through profit or loss, because that is what your rules of IFRS 9 say. We have now looked at the 2009 year. We have looked at what was done and what should have been done. Now we need to write the correcting journal entry, and remember, now we are not opening the 2009 accounting system. We are fixing the effect of the error by writing a journal to fix the opening balance of the 2010 reporting period, because the accounting system allows us to open the 2010 year, so the effect of any year before that, any year that happened before the 2010 reporting period, altogether cumulatively, what is the effect on the opening balances of the 2010 year. Now, in our example, it was only 2009 because that's only when we started to do share transaction, but it could have gone back further. 2008, 2007, 2006, 2005, all those years together, the effect of the error, fixing it between what was done and what should have been done, the difference altogether, what would the effect be on the opening balances of 1 October 2009, the opening balances of the 2010 reporting period. Now, it's really important if you look at the journal entry. If you look at the journal, all the accounts that you are debiting and crediting are balances, statement of financial position accounts. You do not see nominal accounts there, income statement accounts. You don't see revenue, cost of sales, other income, other expenses. You don't see them fixed there because we want to fix balances. So what should have happened? Well, it should never, ever, ever have been inventories. So you need to take out whatever is in inventories, take it out. It shouldn't be inventories. What should it be? It should be investment. So debit the investment, make that more, take it out of inventories, give it to investment. But it wasn't for the same amount because we did completely different things. What other balance gets affected? The balance of retained earnings. And that gets affected with anything that influence the income statement. Take out the revenue, take out the cost of sales, take out the write-down to NRV, bring in the recognition of transaction costs, bring in the recognition of upwards or downwards fair value adjustments, the net effect of all the income and expenses, net effect goes to retained earnings. So fix your retained earnings opening balance.